Welcome to Accounting 201, Financial Accounting at Kapi'olani Community College. In this video, we'll take a deep look at Chapter 6 and discuss the ins and outs of inventory. First of all, we need to know our ending inventory because it appears on our balance sheet as a major current asset. It's used to calculate our cost of goods sold too, in many cases, or at least verify it. At the end of the accounting period or at other opportune times throughout the period, companies need to take a physical inventory. To do that, they count the number of each item of inventory that they have on hand and they multiply that by the cost of each of those items to arrive at the total cost of their ending inventory. Now, it's often not practical to figure the actual unit of the actual item, so companies usually consistently assume something about which cost that cost is. There's three ways to do this, and they're known as inventory methods or also known as cost flow assumptions. The first one is first in, first out, or FIFO. Under FIFO, we assume that the latest costs are remaining in inventory. So if we had a list of our beginning inventory plus all of our purchases, we would start at the bottom of the list to come up with the number of units that we have in any inventory and the related costs. What does this mean about what's gone? All of the earliest units are gone because they were the first out. LIFO is another assumption. In LIFO, we assume that the latest ones in are the first to be gone, and therefore our earliest costs are somehow remaining in our inventory. So looking at a list of our beginning inventory plus all of our purchases, we would start at the top of the list till we came up with the number of units and related costs in our ending inventory. Average takes a little bit of all these units, but because it's influenced by the amount of units that you purchase at various price points, we have to work with the total cost of goods available for sale and total number of units available for sale. So the computation works like this. You take the dollar amount of the cost of goods available for sale, that's your beginning inventory plus all purchases, and divide by the number of units of those goods available for sale, the number of units in beginning inventory plus the number of units purchased. And you arrive at the price or cost per unit. Multiply that by the number of units you have in your ending inventory, and you'll have a number that's very comparable to the FIFO or LIFO ending inventory number, but not the same. Now, what does this do to the inventory that shows on our balance sheet, and what does it do to the cost of goods sold that pops up on our income statement? Now, if we assume inflation, we can also assume that prices or costs of our merchandise that we purchase are going to continue to go up somewhat over time. So what does that tell you? The beginning items are going to be cheaper than the later items. If we have an assumption where the first things in are out and gone and what's left, we'll have ending inventory that's relatively high priced. And the items that have left and gone to cost of goods sold as we've recorded our sales under our perpetual inventory system will be in cost of goods sold at the lower cost of the earlier items. Conversely, if we looked at LIFO as our assumption, then we would say that the earliest costs being remaining in inventory, those are the lower costs. And so our ending inventory would tend to be lower. What would that do? It would take the more recent higher costs and send them directly to cost of goods sold as we recorded our sales. So accountants tend to like LIFO because it's a more conservative measurement. Let's take a look at what each of these guys does to our inventory on the balance sheet and our cost of goods sold. If you have been using FIFO, then relative to all the other methods, your ending inventory will be kind of high, and your cost of goods sold will be kind of low, but your gross profit will also be high, which sounds good to me, except when you consider that the gross profit will be a major determinant of your income tax bill. So if we look at LIFO, then we can say that the ending inventory ends up lower, cost of goods sold higher, and our gross profit lower. And what does that tell you about what business people might like? Well, the gross profit ends up being translated into lower income, and with the lower income comes a lower tax bill, so it's not hard to tell why they might enjoy using LIFO instead of FIFO. Average cost ends up somewhere between LIFO and FIFO, and it's kind of dependent on how many units you bought at which cost. So if we take a look at LIFO versus FIFO for taxes, Then you have to use LIFO for financial statements if you're using it for taxes. International Financial Reporting Standards doesn't recognize LIFO, only FIFO or average. Once you pick a method, you have to use it consistently from year to year. Otherwise, having made a change in it will require you to do all kinds of special reporting to disclose the impact of that change. With inventory comes the possibility that you may have unsold units or items that become unpopular and non-saleable. So we use something called the lower of cost or market rule at the end of any period to just double check and make sure that our assets are listed on our balance sheet at what they are really worth. So we don't want to have them overstated, and we don't want to have our income overstated, and we want to pick up any decline in value in our inventory during the period where it actually happened. So what does market in lower of cost or market mean? Market means what it would take for us to currently replace that merchandise. So computations-wise, here's how it goes. You stack up your cost and market value, or determine the market value for inventory items. And between the two, the lower of these two is the market. So I'm going to use the $5. That's below my cost, by the way. The lower of the second batch is $4. So I'm just going to remain using my cost for my computation. It's possible to do it by category. So I have subtotal to show you the category. If we were doing it by category, I'd probably take the cost, not the market. In category 2, we have items that are $20 cost, $18 market. So we're going to use the $18 market value. However, we have a $28 cost item that's worth $29, so we'll use the lower of the two, 28. So what do you do with it? You take the lower of the two. That's why it's called lower of cost or market. Notice though, in the grand scheme of things, our total cost of inventory was $58, but now since we've used lower of cost or market, we're going to have to adjust it down to $55. That means if this is thousands or hundred thousands or millions of dollars, they have a $3 dollar adjustment in our ending inventory, and as a result, there's also a $3 increase in our cost of goods sold, or an account like cost of goods sold. Last thing, when we're looking at our inventory, we can do some financial statement analysis to take a look at the health or the efficiency with which we handle our inventory. And one of those things is called inventory turnover, or days in inventory. They're two super related measurements or metrics. Now that's what's considered a liquidity ratio. That means it looks at our ability to generate cash quickly. How? By selling it. So what do? You try to figure out the efficiency of management's inventory handling. The higher the turnover, generally the more efficient you can say management is in handling those inventories as a general rule. And now you can compare this year to year or to other companies. So you can do inter-company to other companies or intra-company with ourselves. In this case, we have cost of goods available for sale of $1.5 million, and our average inventory last year's ending, this year's ending, add together, divide by 2, average inventory, and that comes out to 5 times turnover. If we took 365 days in a year and divide by those 5 times, we'd get an average days to sell inventory, or days in inventory, of 73 days. No problem if we're talking about clothing. Big problem if we're talking about milk or dairy products, right? So hope this helps, and you can use these financial statement analysis techniques that come from each chapter when you get to the chapter on financial statement analysis, which I believe is chapter 14. Hope you enjoy the. Thanks for listening.